Yo, what's up, everybody? It is Monday, March 20th. Couple more days until spring officially. But March is always I don't know where you are, but in New York, they call it spring, but it's usually March is brutally windy and cold. It was like, when I ran this morning, it was like 25 degrees. It was like a feels like temperature of 25 degrees. It was 32 degrees. It was cold. Anyway, I sent out the new edition of MMT Trader. You people should be signing up for that. Come on. I mean, seriously. I've been giving you this information for a long time now. I give you exact dates. I tell you about these flows. Sign up. So we had a bounce back. I'll be honest with you. First of all, before I even get into the markets, a lot of you have been sending me really nice comments about the podcast, the interview I did with Borzelino from the CME. I'm telling you, that guy, I traded on 4 different exchanges. Okay, you people know that. I was on the Knife, I was on the NYMEX, I was on the COMEX, I was on the CME. I ran a prop trading desk at Credit Suisse in Zurich. Don't blame me for what happened to Credit Suisse. That was a long time ago, okay? And I managed some money for Paul Tudor Jones for a while. Anyway, so I've been around, you know? And in every pit that I traded, especially like, you know, the 3 that I was a member at in New York. In New York, you know, we had a lot of tough guys there, just a lot of street tough guys. And there were some outstanding people in each and every pit, like in NYMEX. I would say the NYMEX people at the time when I was down there in the 80s, they were a little bit more cerebral, although there were a couple of guys I remember who were, you know, they were as rough and tumble as you can imagine. But NYMEX had a lot of these kind of cerebral guys. There was a lot of like Orthodox Jews. They were really, really disciplined. A lot of them, their approach was mainly playing calendar spreads and stuff like that. The COMEX was a wild place. It was completely different than in NYMEX. A lot of Brooklynites came into the COMEX for some reason. A lot of Italians from Brooklyn, if you know what I'm talking about, those kind of families connected to the mob came into the COMEX. So that was a wild place. But Lewis, when I went out to Chicago, and I said this to him, like the exchanges out there floored me because we had, you know, our exchanges were all housed at 4 World Trade Center, which was in one of the Twin Towers that eventually got knocked down in 9/11. And it was at the time, it was the biggest open, how do you call this, like a non-supported, open-floored, you know, story in a building. But then when I went out to Chicago and I saw, you know, when I became a member out there in 1990, that was on the new Chicago Mercantile Exchange, and it was like, that blew my mind because they were at another level. They were completely at another level in terms of just the size of the place, the technology, their ability to market products. It was an incredible. But anyway, getting back to Lewis, like he was so dominant in that pit, you know. And we went over the story about how there were pit spotters who firms employed just to let them know what Big Italy. He told us what his nickname was, Big Italy. And his brother Joey was Little Italy, what Big Italy was doing. There's only one other guy I knew, not personally, but his name was Tom Baldwin, and he traded treasury bonds over at the Chicago Board of Trade. I was never a member of the Board of Trade, but Tom Baldwin is also a very, very famous guy. I don't know what he does nowadays, but if you ever bought the book by Jack Schwager, Market Wizards, the original book that he wrote, I think he wrote a few different versions, but the original Market Wizards featured a chapter on Baldwin, Tom Baldwin. So it might be an interesting book if you want to read that. Anyway, so I'm glad you enjoyed it. I'm trying to get other people on the podcast. That's the hard thing. Like if any of you have a background as a booker for TV or radio, and you want to collaborate with me and try to help me get some people on, I've been sending out emails, but I personally don't enjoy booking guests. Like I used to do my podcast, which was an audio podcast, and I'm going to go back to doing that for now. But as soon as I can get guests on a more regular basis, then hopefully we'll continue with this. So anyway, the whole bank thing today, I'm going to be honest with you, I'm a little bit confused. All right, I understand that I think some of these smaller and regional banks, they have been, kind of put in a jam because of the Fed rate hikes and what it has done to their, the HQLA, high quality liquid assets, things like treasuries, tier one capital that they own. And I went through this on a video that the FDIC requires them to market these instruments. So when the price of these instruments go down as the Fed raises interest rates, then they don't have enough capital to back their assets. Basically, there's a ratio that they have to comply with, and so that creates kind of like a spiral. But I went over some numbers, and in the year since the Fed has been raising interest rates, all right, they started in March 2022, so we're going to get another one on Wednesday. That'll be like, I think 9 now. I lost count, but anyway, people refer to this as the most aggressive rate hike campaign of a central bank since the Volcker days. Some people even say it's worse than the Volcker days. But in that period, I just went over some numbers. In that period from the last year, bank assets have increased by almost 115 billion. They were a little bit higher last April. I think it was like maybe last April, like a year ago. It was like 22.9 trillion. I think they're 22.8 trillion. But that's still up 114 billion. So bank assets, despite the rate increases, bank assets have gone up, and that's primarily been due to loans because they've been heavily liquidating treasury securities, government securities, MBS, certain types of equities, in the equities that act more like preferred stock, they're more like bonds. They've been liquidating those. But even with that massive liquidation, we still see that bank assets, are very close to an all-time record high. They're at 22.8 trillion. And bank capital, despite, what we keep hearing about the devastation going on and the contagion and how terrible, bank capital in the 1 year period since the Fed has been raising interest rates, bank capital has gone down by a measly 1.8%. Okay? It's 2.137 trillion right now. It was a little bit higher. It's like 2% off its highs. I mean, the way this stuff is described, and the way, it's funny because Lewis, in the interview with Lewis, he said, we were talking about the 1987 stock market crash, which I remember, vividly still to this day. He said, that in a week, the market dropped like 50%, or in 5 days. In 5 days, so it would be like the market be like the Dow going from what, like 33,000 now down to 16,000 in like a few days. Maybe it was 3 days. I don't even remember. I have to go back and check. But, so now we get like freaked out because it's down 300 or 400 points, a percent or 2% or something like that. And then it's back up the next day. I really think a lot of this, again, is just This is drummed up by the media, and because they don't know anything. And these panicky type of articles, they grab attention, they grab eyeballs, people read them. We know what the internet is about. It's about traffic. It's about getting people to look at your stuff, to look at your videos, to look at your articles, etc. And we also have people, unfortunately, who are brought on these shows, especially the business shows, as experts, and they really don't know what they're talking about. And it just makes the whole thing that much more frightening to the lay person, people who are not, that's not their job to follow this stuff. And even those people who are paid to follow this stuff on Wall Street, and I don't know how many times I've said this, that they don't know what they're talking about in most cases. I mean, they absolutely don't know what they're talking about in most cases. And again, I come back to, and I could end up being totally wrong on this, but I come back to the fact that we are running right now, about 600 billion leading spending flow, monthly spending flow rate. I mean, that's way up from the Trump bull market. It's way, way up from even when Obama did the fiscal stimulus, when we had the great financial crash with Lehman, and then in 2009, I mean, we were running at about a 400 billion monthly rate after the stimulus, and right now we're running like around a 600 billion. Maybe on the low side, sometimes a 580, 550 billion. Sometimes on the high side, close to 700 billion. I mean, you talk about liquidity. And again, I've listened to commentary, again, talking about deposits being pulled out. The deposits are going into the Fed's reverse repo facility. And here's another thing that happened late last week. I mean, we had a record increase in I think a single day, or what was it? Was reserve balances or something. It was like 440 billion. A record single day increase in reserve, a record single week increase in reserve balances, 440 billion. The Fed did 303 billion in loans. Remember those loans, the loans that got started back in the beginning of the pandemic? I think it was March or April or May of 2020, and the Fed started making loans. And those loans eventually, most of them got paid back. I mean, at the high point, I don't remember, they were a couple of $100 billion, and then they were down recently to like 15 billion. Most of those loans got paid back. But the Fed did 300 billion in loans last week. So I mean, they're there. There's a lot of things that were learned from the 2008, the great financial crash, that they weren't doing at the time. I mean, back in 2008 with Lehman, the Fed was basically, sitting on its hands saying, oh, we're only going to lend against, the highest quality assets, meaning treasuries, where all of bank assets have to be pre-approved by regulators, by the government. Like I went through this, I've been through this before, like that. The government will not grant you a bank charter if you say, okay, we're gonna invest in something crazy, something that's not on the list of things. I said there's three things. They could have loans, they could have government securities or certain types of securities, and they could have cash. And it's highly regulated. I mean, they can't get into things that are outside of the restrictions of what the regulators deem as acceptable and also discountable. In other words, can be used as collateral for loans from the Fed. It's a whole system that's set up that way. It says, okay, well, will allow you to hold these loans, certain, or will allow you to hold these assets. And certain assets like treasuries, they're basically, you get full face value. I mean, there might be a tiny, tiny haircut on a treasury. I don't know, it could be like, less than 1%. Some other assets like loans, obviously, you're gonna have a bigger discount on it, like, but they're already pre-approved by regulators as collateral that the banks can post to borrow money from the Fed. So I just think the whole thing is getting out of hand in terms of the hysteria and the emotion. But I mean, how often do we see this? The only other thing that bothers me, and I'll bring it up again as I do like in every single video that I've been doing now, like probably for the past 5 months, is we still have the debt ceiling situation. And I don't know, man. It doesn't look like the GOP is gonna, I don't know. I still think, I'm still gonna lean positive on that. And I'm gonna say, I think at the last minute, you know how they do these things with brinkmanship? At the last minute, they're gonna end up coming up with some kind of deal. But they need to come up with a deal, and we need to end this nonsense with the debt ceiling. At least have it suspended or increased for another 2 years or whatever. I mean, otherwise that could be real trouble. And of course, we have the I think it's April 18th this year, tax drain. So there's still going to be volatility in the market. Again, it's hard for me. Let's separate out the debt ceiling situation for now, because I don't know how or if that's going to get resolved. But we'll know. I mean, it'll either be resolved or it won't be resolved. And if it's not resolved, we're going to have to take some serious downside protection. But right now, I continue to say that, look, with 600 billion monthly flows, and a clearly rising trend in the fiscal, that's the water coming out of the pipe going into the swimming pool. I mean, that's clearly the rate of flow is just so clear and obvious that I can't get too bearish when I look at something like that, because remember, that's the first derivative. Everything flows around that. Flow, it's an appropriate term to use. We're talking about water and swimming pool and everything else. Anyway, that's it. I think I'm going to do an audio podcast tomorrow. I'm not quite sure what I'm going to talk about. I'll probably be rambling on as I usually do, but I'm glad everybody enjoyed the Lewis. If you have some suggestions of who I should try to bring on the show, leave them in the commentary. Please don't forget to like and subscribe the video. That helps me grow the channel. And go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. Bye.